Hi, good afternoon. Welcome to Tobias Financial Advisors' third quarter market update. We will be reviewing a lot of different topics in the economic and financial news, and we hope to provide you insight and some comfort during this kind of turbulent year here in the markets. And so thank you for joining today. My name is Matt Sainholtz, and before we get into our presentation, just a reminder, this is a high-level educational session. We'll be talking about some themes that we're seeing throughout the economy and how we're maybe positioning ourselves, generally speaking. Your specific portfolio may be set up differently for a variety of reasons, most importantly related to your goals and how you'd like to see your money managed. So if you have any questions about the information presented today and how it affects you, please reach out to Tobias Financial Advisors and we will be sure to answer any of your questions. Another housekeeping tip before we dive into our agenda today, there is in the webinar functionality a place where you can ask questions. Please do put your questions in there. If there's time at the end of the seminar, we will be sure to address those. Otherwise, we'll follow up with you as best as we can going forward. Tobias Financial Advisors, who we are. Founded in 1980 by Benjamin Tobias as an accounting firm, and in the 1990s, early 2000s, made the shift over to financial planning and investment management. So today, we are a team of almost 20 team members that manages over about $600 million for our clients who are mostly private individuals, personal families, but we do manage some 401k money for some businesses, as well as some charity type of accounts. The idea here is that we have belief that education and doing the right thing will always put you forward, and that's what we're here today to do today, is to educate our viewers about what's going on in the financial markets today. Today's presenters, I'm Matt Sainholtz. I'm the Chief Investment Officer and a Senior Wealth Planner, where I work with both the advisors, clients, as well as the setting forth the investment strategy. We also have Edzai Chemedza as a wealth planner.
Hi, good afternoon, everybody. For those who haven't met me yet, my name is Edzai, and I am a certified financial planner. I have been with Tobias now. This is my third year with Tobias Financial.
Great, Edzai, welcome. We look forward to hearing your thoughts about employee benefit plans in a few moments. And of course, we have our portfolio analyst, Chad Naismith. Welcome, Chad.
Thank you so much for having me. This is, I think, my fourth or fifth one by now, so I'm happy to be on the webinar. And just a little bit about me. I've been with Tobias Financial for a little bit, about a year and a half. I do trading and research for the firm. Some of the clients may know me. I'm in client meetings every now and then, and really happy to be here to share on the economy and investments today.
Great, thank you. So let's dive right into a little bit about, what we believe here at Tobias Financial Advisors is that, we're focusing on what we can control. A lot of what's happening in the world that's around us is something that we cannot necessarily have a tremendous amount of control on, but we can position ourselves to take advantage of what the market opportunities provide. And that means that we're creating an investment plan that's unique to your needs and your risk tolerance and your goals. At the end of the day, your portfolio is here to help you achieve what you want to achieve in life and what you want to do for yourself and your family. So what we do, how we do that is structure the portfolio around different types of returns, different types of risk, different types of correlations that ultimately means that we're going to diversify your portfolio in a broad-based manner, where we're going to have all different types of asset classes. We're going to keep an eye on keeping your costs low, and also keeping an eye on your tax bill. We want to minimize taxes, and this year is no different. With what's going on in the markets, we have found some opportunities to potentially save you on your taxes by taking some losses at certain times in the portfolio. So we're kind of managing all these things with an eye towards the long term and diversification. Today's agenda, we'll be covering a bit of recap of the year-to-date market returns. Then we'll dive into kind of what's driving returns and what's happening with the Fed, inflation, and interest rates. We'll be touching on the midterm elections that are going to be happening here in the United States here in a couple weeks from now. And Edzai here is our special guest today, talking about healthcare enrollment or open enrollment for your benefits through your employer. We are a financial planning firm that focuses not only on investment management, but also financial planning. So we wanted to bring Edzai on today to kind of highlight kind of a pertinent topic with what's going on in most people's open enrollment period. So we'll dive into that too today. So without further ado, let's jump into what's happening in the portfolios and what's happening in the broad-based market year to date. Just visually, there's a lot of different types of asset classes here. There's stocks, there's fixed income, there is value companies, growth companies, technology, different countries, international on the left-hand side. So a bunch of different asset classes. But without even diving into the asset classes, we thought this was a good picture of what's happening this year, where there's only 2 asset classes that are in the green, which are positive year to date, and that's oil and Brazil. And then everything else is negative. This is a year where we are talking about, we're saying that there really hasn't been a good place to hide or a good place to store your money when just about everything that you can imagine is negative this year. So just some highlights, the S&P 500, which is the barometer of the US stock market, is down 24% year to date as of September 30th. The bond market is down about 15%, and that's traditionally more conservative. And I have a slide that will kind of dive into that next, that kind of really sets forth how that ranks historically. But international too, Germany's one of the worst performing countries. China down there at negative 30%. And then even bringing it back to the United States, the NASDAQ, which is down 32%. That's really kind of your traditional technology sector, kind of those growthier names that are more fitted for technology. You think about Apple's, you think about some of the Microsofts and some of those tech names that are really underperforming this year after kind of a multi-year period of outperforming. Everything is switched on its head. And the main reason, and we'll get into it, Chad will touch into it a bit more, but really interest rates have been going up quickly. And that is part of the reason why the different asset classes are being revalued. And we'll dive a little bit more into that later on. But just to hit it home, this just has been a really tough year, unfortunately. Really one of the most historically bad years on record, unfortunately. So in 2022, on the left-hand side is your fixed income or U.S. bonds. The first 9 months of the year, we've seen returns in that particular asset class, that's fixed income, that's bonds, down almost 15%. And that's the worst it's ever been since 1926 as a start to the year. And it's even done for, even dramatically. It's not just by a little bit. The next worst year was 1981, which was only almost -4. So we're seeing a historically bad year for bonds. And then on the other side of the coin here, on the right side of the screen, we're talking about U.S. stock markets. This is the 4th worst start of the year ever since at least till 1926, when the data really was, since we really started keeping data on this. And so, it's really, like I said, it's kind of been a nowhere to hide, because your traditional side of the portfolio that's conservative is down 15%, and your stocks are down 24, 25%. So it's been a really challenging year in the economy and kind of the outlook of what's happening. On average, you can see on the bond side, a negative 3.4% historically. On the bond side, stock side, negative 22%. The good news is that things have repriced in such a way that our forward-looking to returns, what we expect going forward, has improved. And historically, after these periods of downturns like this, it is a positive return. So we kind of commend you for staying invested. And what we have to remember is, we have to fight recency bias. And what that effectively means is that, it's human nature to believe whatever's happening right now is going to continue to happen to the foreseeable future. And that's where sentiment comes in, and a lot of kind of the negative outlook comes in, that, nothing. There's no positive news on the horizon. But we understand that there's cyclical, things change, and we'll provide some information as we move forward on why it might change in the next 12 months as well. And one of those reasons is just valuations. This chart is a measure of the U.S. stock market and the kind of the discount or the affordability, or whether it's expensive or affordable. On average, the stocks in the U.S. and in the United States are priced at about 17 times a company's earnings. And you can kind of see over the last couple of years during COVID and all this kind of free money printing and a lot of money being thrown at the economy to get out of COVID, the stocks kind of ran up. And now it's kind of quite the opposite, where the Fed is trying to take money out of the economy and things are slowing down. And so valuations are kind of back in check, where the U.S. stock market is now more affordable. It's more affordable than it has been in the recent past. And it's actually lower than the 25-year average based on affordability, based on the price to earnings ratio. So with that said, it's kind of a good entry point. The prices have leveled off, have readjusted, and again, going forward, returns are looking better than they have been on the backward looking. And just kind of hit that home one more time. We love kind of thinking about the long term here. We are long-term investors. If you've been with us for a long time, we've seen ups and downs in the markets. And this is just a reminder that, dating back to, again, the 1920s, looking at different time periods and different types of declines in the markets, after different types of declines, whether it be 10%, 20%, and 30% market declines, on average, after 1 year, you're looking at a positive return. After 3 years, cumulatively, it does come back. Markets come back, I think, is the point of this slide. And so, if stick with it, stick to the program. We commend you for. It's very easy to try to react and get defensive, but this would be the wrong time to do that, because the markets have already shifted so far down that I'm not saying tomorrow is going to rebound right back up, but over the next 1 year, the next 3 years, next 5-year period, we're expecting positive returns in the markets. So we're going to pass it over to Chad, who's going to give us a little insight into what's driving markets and what could be some good news and what we're looking at going forward from the Federal Reserve.
Great, thank you, Matt. I really appreciate it. And yeah, thanks for hammering home. Definitely want to stay with it long-term investing. We don't want to react to short-term market fluctuations. We have seen a lot of things come down, but it's just a repricing that has a lot to do with the Federal Reserve. So if you don't know anything about the Federal Reserve, I'm going to give you a little bit of a primer, and then kind of tell you what they're doing with inflation and what the tools they're using and why they're doing all of this. So for anyone who does not know, the Federal Reserve controls monetary policy for the United States. The federal government does fiscal policy, they do spending. The Federal Reserve reacts to that. They try to balance out the supply and demand dynamics for the economy. They have a dual mandate with, they try to maximize unemployment and also have low and stable inflation. So they want stable prices. They don't want runaway inflation that we've had the last year or high inflation. And they do control and they balance those two things with the federal funds rate and also communications. So they control short-term interest rates for the most part, and they also tell the market what they're going to do. So about a month ago at Jackson Hole, about a month and a half ago, the Federal Reserve Chairman Jerome Powell came out and he said, we're going to raise interest rates. We're going to try to slow down demand for the economy. And they didn't have to do any. They didn't have to actually have to change interest rates. They didn't have to do anything. The market reacted to that news. They reacted to the chairman saying that they're going to be tough on the economy, and they are being relatively restrictive, historically speaking. So as they raise interest rates, it controls. It actually affects longer-term interest rates. It affects all asset prices. Interest rates act as a gravity on all financial assets. So that's why we're seeing a lot of assets come down at a medium pace, and the correlations are all relatively high right now. And also we're seeing exchange rates. It's affecting the dollar. You may be seeing in the news that the dollar index is up. It's rallied really heavily on the Federal Reserve increasing interest rates so drastically. And yeah, we expect that dollar to remain high as long as interest rates remain high. But what they're trying to do at the end of the day is slow down demand so they can bring supply and demand in balance. And right now we have a lot of demand. There's a lot of new money out in the economy from COVID spending, a lot of excess stimulus, and the Federal Reserve is trying to balance that, to where we can keep up with the demand. Supply, they can't control what people make. The economy can only make so much at a time. And so they're trying to slow down the economy to control prices without hurting unemployment too much. So let's go to the next slide. We're going to talk about inflation. You may have heard of inflation in the news. There's been a lot of, it's been in a lot of headlines lately because it's high. It's an historic 40-year highs. It peaked last June at 9.1%. It's been creeping up over the last year, over the last 18 months. We originally thought that it was going to be a transitory inflation, but it's since really settled in to be in all parts of the economy. As you can see on the right side, it says food at home is in purple. If you go back to early April, it really wasn't increasing in prices that much. But as you go to the grocery store now, there's some sticker shock for a lot of people, myself included, for all kinds of groceries at the store, and also ordering out. Prices are going up for all food. Energy, earlier in the year, we saw $5 gasoline prices. That's come down a little bit. Gas isn't as crazy as it once was, a little bit from, I believe there was some strategic reserves released earlier in the year, but that's come down a little bit. Gas prices are a little bit more manageable. New and used car prices, that has actually come down a little bit. We're starting to see inflation peak a couple months ago, and now we're seeing it go from 9.1% down to 8.3%. So a lot of that's gone from this transitory inflation that we saw earlier in the year, and now it's starting to cool off. But on the bottom side of that, the sticky stuff at the bottom, you see the gray, the light blue, and the dark blue. That's restaurants and bars, hotels, transportation. Shelter has to do with rent, and shelter takes up 33%, about a third of CPI data. And some of that has to do with rent, and some of that has to do with owner-occupied inflation. So we expect to see shelter continuing to increase over time, and part of that has to do with rolling rents. So, for example, my rent came up in February, and it was a very big increase all of a sudden. It was up 25-30%. So I went from paying, overnight 25% more than I was paying the month before. But there's a little bit of lag. So people that signed leases last November, the prices may not have moved up all the way, or they may not have had a chance to reset their rental agreement. So we may see that kind of bleed into over time, that inflation over time. But for the most part, we do see inflation peaking. We're seeing inflation come down in durable goods. We're seeing inflation go down in furniture, appliances, stuff like that. We're seeing it roll down. So that's great news for us right now. Part of that has to do with what the Federal Reserve is doing, and part of that has to do with just generally the economy slowing just a little bit to control these prices. So let's go on to the next slide here. This is the federal funds rate. This is a chart of the federal funds rate. This is the interest rate that the Federal Reserve, changes to restrict or be accommodative to the economy. And as you can see, this goes back to the year 2000 at the far left. And as the rate goes up, that's the Federal Reserve being more restrictive to the economy. And as it goes down, they're being more forgiving, or dovish is what they say. So after the Great Recession, they kept interest rates at an all-time low for a very long time. And then they slowly increased the rates between 2016 to 2018, then right before COVID. And then now you can see there's a spike. And they're really behind the curve because we've seen inflation run away from us a little bit. And so the Federal Reserve's playing catch up right now. And historically, they would only increase interest rates by 0.25% per meeting. They meet 8 times a year. But ever since they started increasing interest rates, it's gone up 0.75% each time. And we expect next meeting that they're going to do the same in November. But right now, the market is expecting, the expectations of the market are in line with what the Federal Reserve is saying they're going to do. So we're expecting to have interest rates high for the next couple of years, or higher than we've seen in the last 10 years, up to 4.5%. And then eventually, several years down the road, it should settle down to a long-term rate of about 2.5%. That's expectations. It'll take several years for that to happen, but for the next couple of years, we're expecting to have short-term rates to be not zero, which is a change for a lot of individuals because we are picking up some yield in some bonds. So that's great. if you have any short-term cash, it'd be a good time to put it to work and to earn a little bit of money on your cash. So yeah, that is that's a short-term interest rates. Let's go into the bonds. So this is, you may have heard that bond yields have gone up, bond prices have come down. A lot of fixed income returns have been, all-time poor this year. We saw earlier, Matt shared that slide, down a little bit over 14% at the end of September. But the good news is, going forward, you're actually getting paid to invest in fixed income right now. So if you look on the left side, you have a 2-year treasury that's yielding 4.3%. It hasn't yielded that in a very long time. 5 years yielding just over 4 as well, 4.14. The 10-year treasury is yielding under 4 at 3.89. And if we want to invest in investment grade corporates, it's yielding 5.7. And the US high yield, just 2 lines below that, is yielding almost 10%. If you invest in a high yield bond, you're going to pick up 9.28%, which is, I haven't seen that yield since I started in the business. And so these are promising numbers that you're actually getting paid to invest in fixed income. So forward-looking returns are looking pretty promising. And so people may be maybe a little bit scared to invest in fixed income, given how the poor returns have been year to date. But on the right side, you can see what happens when interest rates rise or fall. And rates have risen really quickly in a really short amount of time this year. That's why I've seen the 10-year is down over 17% year to date. However, if rates were to rise 1% again, and you hold a 10-year treasury, you're only going to be down another 4%. But if they were to fall, you would actually get a 12.6% positive return by falling 1%. And so that trade-off is getting more and more promising as rates have gone up. Normally, you would see a higher than negative 4% if rates were to go up 1%. That's what we would saw at the beginning of the year, but now it's come into more line, come into a better risk and return profile ever since rates have come up a little bit. And what we've done in our fixed income portfolios, I'll talk a little bit more about this later, but we have invested more heavily in the 2 and the 5-year part of the yield curve. And so we do like the higher yield right here in the 4.3, the 4.14. We do like picking up a higher yield, but also reducing our risk. So if you were to compare the higher yield on the left side and then the top part of the right graph here, if you were to hold a 2-year US Treasury and rates were to go up 1% over a year, you would still have a positive return. And so we do like that trade-off. We do like investing, and investing in a trade-off like that. If you have a 5-year Treasury and rates go up 1%, you're going to be break even. But if they go down 1%, you'll have almost a 9% return in a 5-year Treasury, which is was pretty nice. So I believe that's all my comments I have for fixed income. I think we'll pass it over to Edzai right now. Cover.
All right.
No, that's going to be Matt. Matt's going to talk about midterm. Sorry.
Let me chat on midterm.
Yeah, midterms.
For a moment. We'll be coming up here on just a couple weeks from now. I'm sure you're getting, if you're like my phone, it gets random text and phone calls from all sorts of politicians trying to get my vote for the midterm elections. But I wanted to just share a little bit of data and then what that means for the market. It's kind of an interesting statistic that we came across recently here on our research team. This one is just really about if the net change in the House of Representatives from the controlling president's party at the midterm elections. So the Democrats are obviously at President Biden's in control at the moment. Typically, historically, the controlling party loses seats in the House of Representatives, and you can kind of see historically on the left here all these negative numbers that, yes, on average they do lose seats. Only the most recent times where they actually gained seats were back in 1998 and 2002, when the sitting or the incumbent president's party actually gained seats at the midterm. So, I guess if you base it on history, we wouldn't be too surprised if we saw some Republican gains in the House of Representatives. But we stay far away from politics here, but I just thought this was kind of interesting. But what does this mean for the markets in a midterm election year, and what has historically meant for the markets as well? And allow me a second to review this chart with you, but it's just rather interesting to me. So we have 2 sets of lines here. The first line on the top is the black line, and that is all years dating back to 1931 that were not midterm election years. And then we looked at the average midterm election years here on the blue line below. And so what this is showing is we're looking at focusing on midterm elections year on average, dating back many years ago. The midterm election years are kind of flat compared to all other years. So all other years, you can kind of see it increases up and through the 9-month returns, and then even into year end. Whereas midterm years, there's uncertainty. There's uncertainty in the markets. There's uncertainty. You're getting all these messages. The investors getting different messages of what kind of tax regime we're going to be under, what kind of what kind of government regulations will be in place during that time, which may or may not favor different industries. It's just kind of an uncertain time during midterm election years. So historically, the returns have been muted. But once you get past the actual election day, towards the end of October or even in November, early November when elections are, you can kind of see that then that uncertainty is lifted and returns are higher than other years. So that's very interesting to us. We are, markets don't like uncertainty. And so we are expecting a kind of a deep breath by the markets when the post midterms have occurred, and maybe we'll be like on average like prior years where there is a run up towards the year end after some of the uncertainty is removed, and you can kind of see which party has gained control or what's happened in the election. So just a kind of an interesting fact, and just to kind of goes to show you that not only this year has been a tough year due to the interest rate increases and the potential for a recession either now or into the future, but also we have midterms in addition to the geopolitical issues that are happening around the world. So it's been a lot of headwinds, midterm just being another one to the list. But the good news is potentially when they're done, there could be an upside to that. So we'll be waiting to see what happens here in the end of the fourth quarter. So Edzai would like to invite Edzai on to talk to us about open enrollment through your employer.
All right. Thank you very much, Matt. And there is good news on the horizon here as we approach what I consider the most wonderful time of the year, right? We've got Halloween coming up. We have Thanksgiving coming up. We have Christmas, and we have my favorite, open enrollment is coming up. So for my presentation here, though, I'm going to keep it high level. I want to keep it light but informative because my purpose here is not to try bore you into submission. So I'll just start off. I have a definition here of what open enrollment is. So open enrollment, it's a period of time when employees may elect or change the benefit options available through their employer. These are benefits such as health, dental, and life insurance. So simply put, in plain English, this is when you are able to select your insurance coverage and other perks that are offered through your employer. So it's a very, very, very important time of the year and something that I believe we should take seriously. So having said that, Matt, if you don't mind switching to the next slide, there is a statistic that I wanted to share that I came across here, right? The average employee will spend 18 minutes enrolling in their benefits, right? Yet the average consumer, when they go out, they will spend 4 hours deciding to purchase a cell phone. That made me stop and think a little bit, right? Because of how important it is to be appropriately insured. But I went around and I started surveying my family members and kind of sharing this with them and trying to find out what they think. And the universal answer that I got was, well, nobody understands this stuff. Right? And that didn't actually shock me because I kind of go back a few years to when I selected my benefits. And I think I'd be generous if I said I spent 18 minutes. I spent probably 2 or 3 minutes, right? You open the brochure and it just looks like the ingredients for alphabet soup, right? I had an HSA, an HMO, a PPO, a 401k, an FSA. It was just so overwhelming that I really just went to HR and I asked them, what does everybody else select? And that really was how I chose my benefits for a couple of years. But now I'm kind of looking at it a little bit differently. And that's really what I want you to do when you're looking at your open enrollment options, right? Is you want to reframe how you think about it. And I'm going to start with that word of benefits, because I think when we are thinking about benefits, what comes to mind is gains, right? What am I gaining by choosing these things? And if you don't see the upside, then it's more like, why bother? That's not for me. But in reality, that's really not when, benefits benefit you. If you think about it, it's usually when something bad has happened that the benefits kick in. So if you're sick, well, that's when your health insurance becomes useful because you go to see the doctor. You eat too much candy and you get a cavity. Well, that's when the dental insurance kicks in and you're using that coverage. If you get hurt and you can no longer earn a paycheck, well, that's when the disability kicks in and replaces that paycheck. So really, benefits that you're receiving are more about protecting your downside rather than, how do you benefit on the upside. So I want to reframe it that way. And instead of thinking of it as benefits, let's think of it as providing yourself with a financial security blanket, right? The benefits are tools that should be solutions to life's problems when they occur, right? It always fascinates me that we're able to insure our stuff appropriately, right? I mean, my car is fully insured and the house is fully insured. But when it comes to insuring some of the things that are most valuable to us, I think we struggle a bit more in getting that, right? So your personal health and your security, that's of value. And of course, your family's security is of value. So understanding how do I protect what's most valuable to me, I think is of utmost importance when you're going through your open enrollment package, right? So it's probably something you want to spend a little bit more than 18 minutes glancing at, and you definitely don't want to check off the same box that the other guy checked off. If we can go to the next slide, Matt. So we are financial planners, right? So the main question, of course, is where do my benefits fit into my financial plan? The most visible benefit is going to be your retirement accounts, right? Whether it's a 401k, a 403b, a 457b. A lot of these, they all do the same thing. They are tax advantaged accounts. So you put your savings into that account, and as it grows, the interest doesn't get taxed and the growth doesn't get taxed, right? There's two different types of these tax advantaged accounts as well. You'll have your traditional version and your Roth version. And that just, if it's traditional, it just means you pay taxes later on, right? Whereas when it's Roth, you pay taxes upfront. So you just think about it as, do I want to save now and pay later? That's my traditional option, right? I'll save on my taxes now and I'll pay taxes later in the future. Or do I want to pay my tax now and enjoy my savings a little bit later? That's your Roth. So your financial advisor is able to model this out for you and kind of see which option will work best for you. And if your financial advisor is not able to do that, I know a few at Tobias Financial that can. All right, so another important thing, of course, is once you've decided how you're going to save your money, you also don't want to miss out on any free money that may be on offer, right? So anytime your employer is trying to put money in your pocket, you should seriously consider taking it. Right. So an example of that is your 401k match. If there is a match in a 401k, try your best to at least put enough money in there to get that match. Because what's basically happening there is you are being paid to save for retirement. So it's almost like you put in $1 and you get given $1 for doing that up to a certain amount, right? So understanding where it is that my match ends, I think is a very basic requirement and something that you really should talk to somebody to fully understand, because you don't want to be leaving money on the table. There are employers out there who may have certain breaks that they give you based on the kind of health insurance that you select, right? If you take a high deductible plan, for example, and open an HSA, an employer may be willing to contribute money to your HSA because you're helping them offset some of their costs by not using the more expensive health insurance plan. Now, of course, everything is unique to the individual, so you do have to make sure that an HSA is correct for you, right? There are employers out there as well who, if you don't use the health insurance coverage, they might actually give you money for doing that as well, right? I think of an example of a client I had once who the husband had a fantastic healthcare plan that covered the entire family. Well, in that situation, the spouse didn't need to get any coverage from her employer, but her employer was willing to to provide her with a cash rebate for not using the health insurance plan. So it made sense for her to not take up this coverage, right? So if she had done what I did and just checked the box that the other guy did, they would have missed out on a lot of this free money. There are employers out there as well that have wellness plans. These wellness programs, what they do is they encourage you to basically look after yourself. So you might, they might say, if you connect your Fitbit to our account and we track that you're hitting your 10,000 steps every day, well, you get $50 at the end of the month just for looking after yourself and being more preventive in your outlook on life. So you got to ask yourself, well, why would they do this? Trust me, it's not altruism. They would much rather give you $50 to go for a jog rather than pay a cardiologist $50,000, for performing a triple bypass surgery on you. So it's in their best interest that you stay healthy, in your best interest that you stay healthy as well. So a lot of these things are things to think about when you're looking at your healthcare plan. Right? Does it cover my family? Do I need to get any additional coverages as well to make sure that me and my family are looked after and protected? Right? Like I said, it is more of downside protection rather than trying to figure out what the benefits and the gains are. So it really is a security blanket. And nothing is going to sink a financial plan faster than when the unexpected occurs. Nothing will sink a financial plan faster than something that happens that you are not prepared for, right? Warren Buffett has a very famous quote about risk, and he talks about how it's only when the tide goes out that you find out who's swimming naked. So you don't want to be that guy. You want to make sure that you have picked the appropriate benefits to make sure that you have adequate coverage. So this is important not just for new employees that are coming in and looking at open enrollment for the first time, but also if every year you should be reevaluating that and looking and asking yourself, has anything changed in my life? Has anything changed in my family's life? Or has my employer changed something about the benefits package that was there last year? It's open enrollment is a two-way sword as well. It's not just purely about the employee. There is an employer side of this as well. And I know some people on the call are going to be employers, right? So when you think about it, employee benefits should not be looked at as some kind of zero-sum game or something that my employees are taking from. They really can be tailored to become very powerful retention tools, and they can be very powerful recruitment tools. Most business owners will tell you that turnover is one of the biggest headaches that they have. If you have a good enough benefits package, it could be something that provides that stickiness within your workforce. So there are smart ways to implement it, right? You have to look at the workforce and understand your workforce. The slide here shows that it's not out of the ordinary to be in an office where you have baby boomers, a Generation Xer, a millennial, and a Gen Zer. Right? All of these people are at different stages in their lives, and they might require different benefits, right? So you really want to have an understanding of your workforce and try to come up with a benefits package that everyone can participate in, right? The future of work looks very, very different to what it used to be. So a lot of people are looking at their voluntary benefits. This will be things like dental, vision. Those are the traditional ones. And they're adding on additional sweeteners that might be more appealing, especially to the younger generation. So you've got to think of things like student loan repayment assistance programs, training programs for employees. Pet insurance is actually a pretty big one. So all these kind of things that you can really think about to fine tune your benefits. And it might equate to savings. It might equate to you keeping more employees happy and satisfied at the workforce. But it really is something that, like I said, you really want to spend a little bit more than 18 minutes looking at that. So like I said, this is going to be high level. It's going to be light, but hopefully informative. If you do have any questions or you need any assistance with reviewing your benefits, feel free to reach out to us or put a question in the chat box.
Thank you, Edzai. Really appreciate that look into a very important financial planning topic during this time period in this last quarter of the year. Now back to Chad here. We're going to wrap it up with some kind of outlook type of comments. So Chad, take it away.
Thank you, Edzai, for that topic. That was really informative. I really appreciate you putting that together for us. So we're gonna wrap it up. We got a few slides left. I'm gonna start out with points of optimism, the good things. There are plenty of good things. going to highlight a few of them for you. The first thing is the labor market is strong. The economy is still adding jobs. We added just over 200,000 jobs last month. Unemployment rate is just under, it's actually at 3.5%, which is a historic low. We expect it to, not hold there for too much longer, but not really, take off either. So for now, labor demand is really strong. And so people are still getting jobs. No one's losing jobs. That's great news. We're actually seeing inflation start to ease with this strong labor market. Normally you see people start to lose jobs, then prices come down. But we're actually seeing it, prices come down without people having to lose their jobs yet. So that's great. That's fantastic news. I think we've seen peak inflation and the market's expecting the same thing. And then the last thing to highlight is, we talked about it earlier, is bonds are yielding more than they have in the last 10 years. Bond yields are at a relatively high percentage right now. So it's a great time to invest in fixed income. So let's go to the next slide. I think we have some points of caution to cover. Points of caution. So the Federal Reserve it's tightening monetary policy really rapidly at a really fast pace. We talked about a few slides ago. The Fed funds rate is really skyrocketing. It's going to get up to 4.6, 4.5% mid next year. So the Federal Reserve is really having to balance having a balancing act between slowing the economy down or letting it run. And if they get it wrong, it could backfire. It could backfire and we can go into a recession. It could be a worse recession than we expect. But that's something that we're watching. We're watching it very closely. The second thing is the yield curve is inverted. And then what we mean by that, we covered it a little bit earlier, where the 2-year yield is yielding 4.3%. And the 10-year Treasury is yielding 3.89%. You see it's a lower yield for the 10-year Treasury. Normally that relationship is you get paid more to invest in 10-year Treasuries than you do in 2-year Treasuries. But right now you're getting paid more to invest in 2-year Treasuries. And that is historically a sign of an impending recession on the way. So we're going to monitor that, and we're monitoring the economy every day. And the last thing to talk about is third quarter earnings. Just a few weeks ago, people were expecting earnings to come in possibly mixed or poor. We actually have had some pretty good news. We've heard from several companies. We've heard from Johnson & Johnson, Walgreens. We've heard from, who else have we heard from? We've heard from the banks, Domino's, Delta, Pepsi. All these companies are actually kind of saying the same story. And the consumer is still spending. So even though there's higher prices, these companies are being able to pass along these higher costs to the consumer, and earnings aren't nearly as bad as a lot of people fear. So earnings are flat. They haven't grown a lot, but they haven't really they haven't rolled over either. So even though it was a point of caution now, but now we're actually getting some data, and it's actually good news. We've rallied on that news recently, so it's great.
Yes, and just to add there, a couple of things. So if you hear the term soft landing and kind of in the financial press, that is exactly what Chad was describing there in that first bullet point, where they're trying to just time it just right, where they can slow down the economy without losing a lot of jobs or putting the economy into recession. A lot of people are we going to be in a recession or not next year? And I've used this before, but I have to say it again. It's recession sounds like a very 4-letter word or a nasty word, but it's also kind of compared to weather. It could be a light rain or a really hard rain. And by most accounts, if we do go into recession, most people are expecting to think of it more of a mild, a light rain type of recession, where it's kind of slow. It's a low, the growth isn't too terrible, and the unemployment does go down. People unfortunately do lose their job, but it's not such a pendulum swing where we get into a really deep or nasty recession or even beyond that. So I just wanted to point that out and add to some of Chad's comments there. And so we're going to stay invested. And what are some of the things that we're looking about in our portfolios, Chad? Yeah,
so the portfolio positioning in this environment, we're going to talk about fixed income first. Right now we're lowering duration, meaning we're buying more the 2-year and the 5-year notes. We're positioning our portfolios to be more heavily invested in that area so we can get a higher yield and also lower our risk. So if interest rates were to continue to rise, we wouldn't be hurt as bad on the downside. But we're actually getting paid more to invest in that area right now than we are to take on the risk. So that's what we're doing in our fixed income section. Stocks, we're always looking for chances to buy and rebalance portfolios. We've been buying on the way down. We've been selling bonds and buying stocks to keep your portfolio within the mix, within the long-term mix that we like, and within that risk profile that your financial planner has set for you. We've taken a lot of tax losses this year, so we would sell out, but then buy something similar. That's called a tax loss harvest, and that way we can bank those losses that you can use to offset future gains, or also write it off on your tax return. So you can use those losses. I think you can write off $3,000 a year right now on your 1040. So that's what we're doing on stocks. We think the quality companies are still attractive, companies that can withstand recessions, and yeah, we're still invested for the long term. So the opportunistic side of our portfolio, we're still defensive in this area. This is an area that we can kind of go anywhere. Right now, we're still riding out some of the inflation. However, we're strongly looking at making a big move into risk assets. That's something that we're discussing internally, but we don't have nothing to announce right now. But right now, we're defensive in that area, but we could make a move in the next few weeks or next few months on the opportunistic side. So that's where we're positioned, I believe. Let's see what we have next, Matt. Yeah.
Yeah, thank you, Chad, for your comments, and thank you, Edzai. We do not have a lot of questions at the moment coming into our webinar, and we are coming up on our allotted time here, about 45 minutes. So we wanted to wrap it up and let you get on with the rest of your day, and we appreciate you being here. Thank you for joining us. We try to educate and inform and inspire you to live the life that you want, and that's what we do here at Tobias Financial Advisors. Please reach out to us anytime you have a question about something you saw in the financial press, or something that you saw in your portfolio, or just any sort of questions that you may have. We are a firm that loves to chat with you about whatever's going on in your financial life. So Edzai, Chad, thank you, and thank you to all of our attendees today.
Thank you so much.
Have a good afternoon, everyone.